Introduction to Risk in Investing. What is risk? Welcome to today's video, where we will dive deep into the concept of risk in investing, a central theme in Benjamin Graham's investment philosophy. When most people think about risk, they often equate it with volatility, the daily fluctuations in the price of stocks, bonds, or commodities. But for Benjamin Graham, true risk was not about short-term price swings. In fact, he believed that volatility was not risk at all. For Graham, the real risk in investing lies in the possibility of permanent loss of capital, a situation where an investor makes a mistake that results in the total loss of their invested money over the long term. This distinction is critical, as it shifts the focus from worrying about day-to-day price movements to managing the probability of making mistakes that would lead to permanent losses. In this video, we'll explore Graham's concept of risk, including how he distinguished between volatility and permanent loss of capital, and why it's important for investors to focus on long-term capital preservation rather than short-term price movements. Graham's philosophy. True risk is permanent loss of capital. Benjamin Graham's approach to risk was grounded in the idea that the true risk of investing is not the ups and downs of the market, but the potential for permanent capital loss. According to Graham, volatility is a natural and expected part of the investment process. Markets fluctuate, companies rise and fall, prices move up and down, sometimes without any real reason. But true risk emerges when an investor is unprepared, unaware, or irrational, leading them to make poor investment choices that could result in the complete loss of their investment. Example: let's say an investor buys a stock that looks promising, based on speculative trends, perhaps driven by market hype or a hot industry, however, without proper research or understanding of the company's intrinsic value. They are exposed to the risk of permanent loss if the stock's price crashes, and there's no real underlying value to recover from. This type of risk is what Graham warned investors to avoid. Graham's key point was that while volatility, short-term market fluctuations, is unavoidable, it should not be mistaken for real risk. Volatility is simply noise, it's part of the market. But if you understand intrinsic value, if you purchase investments that are undervalued and have a strong margin of safety, you can weather the volatility and avoid permanent losses. The role of margin of safety in risk management. One of the cornerstones of Benjamin Graham's philosophy is the margin of safety. This is the concept that, in order to manage and mitigate risk, an investor should buy assets for less than their intrinsic value. By doing this, the investor creates a cushion against potential losses, ensuring that even if things go wrong, the loss is limited and not permanent. For Graham, the margin of safety was the key to risk management. It acts as a buffer that protects investors from market volatility and unexpected negative events. For example, buying a stock at a significant discount to its intrinsic value means that if the market drops or if the company faces unforeseen difficulties, the investor is less likely to suffer a total loss. The margin of safety gives the investor room to make mistakes and still maintain their capital. Real-world example: imagine a stock worth $100, but after thorough analysis, you determine its intrinsic value to be $70. If you buy the stock for $50, you've created a margin of safety of $20. This means that, even if the company doesn't perform as expected or the market dips, your loss is limited. Identifying risk in investment. The importance of fundamental analysis to effectively manage risk. Benjamin Graham believed that investors must rely on fundamental analysis. This involves a thorough examination of a company's financials, business model, competitive position, and future growth prospects. By understanding the underlying value of an asset, investors can make informed decisions about whether it's a good time to buy, hold, or sell. Fundamental analysis helps identify hidden risks that may not be immediately apparent from market price movements. For example, an investor might see a stock price going up and assume that it's a good investment, but upon deeper analysis, they may discover that the company's earnings are declining, its debt is rising, and it's in a saturated market. In this case, buying the stock could expose the investor to greater risk. For Graham, risk wasn't just about external market conditions or short-term volatility. It was about understanding the true value of an asset. When you understand the fundamentals, you can better assess whether an asset is worth the risk and, more importantly, whether the margin of safety is sufficient to protect your capital. Volatility versus risk. Understanding the difference, it's essential to differentiate between volatility and risk in the world of investing. Volatility refers to the short-term fluctuations in the price of an asset, often driven by market sentiment, economic news, or speculative trading. These fluctuations can be large, but they don't necessarily reflect a change in the asset's intrinsic value. Risk, on the other hand, is about the likelihood of permanent loss of capital. Risk is something that arises when an investor buys an asset based on faulty analysis, speculation, or a misunderstanding of its true value. Volatility is a natural part of markets, and intelligent investors know how to navigate it by focusing on long-term value rather than short-term price movements. Graham believed that by focusing on value investing, buying assets below their intrinsic value with a margin of safety, investors could avoid a true risk of permanent capital loss, even in the face of market volatility. Risk in different asset classes, stocks, bonds, real estate. Understanding risk across asset classes. Different asset classes come with varying levels of risk. As an investor, it's crucial to understand the unique risks associated with each asset type and how they contribute to your overall portfolio's diversification. Benjamin Graham's approach to investing isn't just about reducing risk, it's about properly balancing risk across different types of investments. Stocks. Equities. Stocks offer the potential for high returns, but they come with high volatility. The risk associated with stocks is primarily the risk of permanent loss of capital, often due to poor company performance, management failure, or adverse market conditions. Graham's approach to stock investing focuses on finding undervalued companies with strong financials and a margin of safety to minimize the risk of permanent loss. Bonds. Fixed income bonds, in general, are considered safer than stocks because they provide regular interest payments and are less volatile. However, bonds carry risks, particularly credit risk, the risk that the issuer may default, and interest rate risk, the risk that bond prices will fall as interest rates rise. Graham suggested that investors focus on government bonds and high-quality corporate bonds, offering a stable return while minimizing downside risk. Real estate. Real estate is another asset class with unique risks, such as market risk, fluctuations in property values, liquidity risk, the difficulty in selling properties quickly, and tenant risk, the potential for property vacancies or non-payment of rent. Rights. Real estate investment trusts provide a more liquid option for investors looking to add real estate exposure to their portfolios. Understanding the risks in each asset class and how to diversify across them is a key part of managing overall portfolio risk. And following Graham's principles, behavioral biases and risk. Overcoming emotional decisions, how psychological biases affect risk. Behavioral finance has revealed that human psychology plays a significant role in investment decisions. Emotional biases, such as fear and greed, can cloud judgment and lead to poor risk management. Benjamin Graham understood the powerful influence of psychological biases and how they could amplify the risks of investing. Common biases that contribute to risk include overconfidence bias. Investors who are overconfident in their ability to pick stocks may take on excessive risk, believing they can outperform the market. This often leads to concentrated investments in speculative stocks without proper analysis or diversification. Loss aversion. Investors fear losses more than they value gains. This bias often leads to a knee-jerk reaction, such as selling off assets during market downturns without considering the long-term value of the investment. Herding behavior. Many investors follow the crowd, buying stocks simply because everyone else is buying. This behavior drives up asset prices based on speculation, rather than the intrinsic value of the asset, increasing risk. To overcome these biases, Graham advised that investors must adopt a disciplined, unemotional approach to investing. This means sticking to an investment strategy based on reason and fundamental analysis, and avoiding the temptation to act on fear or greed. Implementing objective decision-making strategies and maintaining emotional control are crucial in managing investment risk effectively. The defensive investor, reducing risk through a conservative strategy, building a low-risk defensive portfolio. Benjamin Graham's advice for the defensive investor, someone who prefers a conservative Kment's strategy was to focus on capital preservation rather than aggressive growth. The defensive investor's goal is to minimize risk while still achieving steady, reasonable returns. The defensive investor's portfolio typically includes a combination of bonds and large-cap stocks, particularly stocks of well-established companies with a strong track record and stable earnings. For Graham, the defensive strategy is about stability and consistency, not chasing high returns. Some key strategies for defensive investing include asset allocation. Graham recommended a balanced portfolio with a mix of stocks and bonds. The exact ratio would depend on the investor's age, risk tolerance, and financial goals, but the emphasis is on diversification and safety. Blue chip stocks. These are well-established companies that provide stability and consistent dividends. Blue chip stocks are less volatile and offer steady returns, making them a good fit for defensive investors looking to preserve capital. Government bonds. Defensive investors also focus on high-quality bonds, particularly government-issued bonds, which are relatively low risk. These bonds provide a stable income with minimal risk. For defensive investors, risk isn't about avoiding all investments. It's about managing downside risk while maintaining adequate returns for their financial goals. The enterprising investor, taking on more risk for greater returns *, active investment and greater risk. While Graham's defensive investor focuses on safety and stability, the enterprising investor is willing to take on more risk in exchange for the possibility of higher returns. The enterprising investor is someone who is actively involved in their investments, conducting thorough research and making more concentrated bets on undervalued assets. For the enterprising investor, risk is an inherent part of seeking higher returns, but even so, Graham cautioned against speculative behavior. The enterprising investor must still follow value investing principles, investing in assets that are undervalued and have a clear margin of safety. Some strategies for enterprising investors include value stock picking. Enterprising investors often focus on undervalued stocks that have the potential for high growth once the market corrects its price. This requires a deep understanding of financial statements, company fundamentals, and market trends. Special situations. Sometimes, the enterprising investor looks for special situations such as mergers, acquisitions, or distressed assets that provide opportunities to purchase undervalued assets with high upside potential. Diversification with concentration. While enterprising investors may take on more risk, they also concentrate their investments in sectors or companies they believe are undervalued. However, Graham emphasized that even the enterprising investor should not over-concentrate their holdings. While enterprising investing can lead to higher returns, it's essential to balance risk and reward and avoid speculation based on emotions or market hype. Conclusion. Implementing risk management into your strategy. Final thoughts on managing risk in investing. Benjamin Graham's philosophy provides a timeless framework for understanding and managing risk in investing. For Graham, true risk is the possibility of permanent loss of capital, and managing that risk is key to long-term success. Throughout this video, we've explored how to assess and mitigate risk through concepts like the margin of safety, volatility, visa risk, and understanding risk across different asset classes. Whether you're a defensive investor focused on safety or an enterprising investor seeking higher returns, the key to successful investing is in managing risk effectively. By following Graham's principles, whether through a defensive, conservative approach or an active, enterprising strategy, you can build a resilient investment portfolio that prioritizes capital preservation while seeking growth. Remember, investing is not about avoiding risk entirely, but about understanding risk, controlling it, and taking calculated steps to avoid the permanent loss of capital. By staying disciplined, sticking to your strategy, and remaining unemotional during market fluctuations, you can navigate the complexities of investing and secure long-term success. Thank you for joining me on this deep dive into understanding risk, not just volatility, and for exploring Benjamin Graham's timeless principles on managing risk in investing. I hope this video has provided you with valuable insights into how true risk is not about short-term price fluctuations, but about protecting your capital and making informed rational decisions over the long term. If you found this content helpful, don't forget to like, subscribe, and click the notification bell so you never miss an update. I'd love to hear your thoughts. What do you think about Graham's approach to risk? Feel free to share your opinions or ask any questions in the comments below. Investing is a journey, and with the right mindset, discipline, and strategies, you can navigate the complexities of the market with confidence. Stay disciplined, stay informed, and keep investing wisely. To overcome these biases, Graham advised that investors must adopt a disciplined, unemotional approach to investing. This means sticking to an investment strategy based on reason and fundamental analysis, and avoiding the temptation to act on fear or greed. Implementing objective decision-making strategies and maintaining emotional control are crucial in managing investment risk effectively.